Okay, recording the session now. I'll send a copy of this out a little bit later this afternoon, so people can review it again. All right, so trading end of year seasonal pattern with options and sector ETFs. This is usually the time of year I always say this is our most profitable time of year, the October to April time frame, because there's certain seasonal patterns that are just the best to capitalize on. So some of you already seen this, but this is the list of ETFs which we trade. We trade these with options and we also trade shares also. I don't usually present the share strategies at the meetups, but it's probably been at least, last time I presented how to trade the shares was probably 2000 and maybe 8 or 9 was the last time I did the share strategies. Someone's calling, let me turn that off. Okay. So but these are the only ETFs we trade. The reason for this list is because these have enough options, open interest, and volume to be tradable. There are probably 1,000 ETFs out there, but most of them don't have enough option volume and open interest to make them tradable with options. If you were buying the shares, it's great, but with options, this is a list which we focus on. There are a few more, but let's take a quick look at a seasonal pattern. Um, Give you the highlight, and we'll take a look at the charts in a little bit. We're in this August time frame, the second. So it's kind of what we saw, and I was expecting a market pullback early in August, and that's basically what we saw. I expect this to begin for August for to see a market pullback, and we had that end of July, beginning of August, and then we see it tends to get a little bullish in the second half of August, and that's kind of what we're seeing. Okay, this seasonal chart is from Seasonal Trader. You can go to seasonaltrader.com, access all of these charts, and this is 40 something years of data. This one ends in 2021, but the last 3 years just haven't updated it yet, but really hasn't changed. Still maintained the same type of market patterns. So if you want the full updated stuff, just go to seasonaltrader.com and you'll have access. This is Jake Bernstein's site, and you can have access to these charts in detail for multiple sectors and commodities, markets, so on. So a lot more there. So feel free to check out Seasonal Trader. It's something I've used in the past, and it's really good. But the main one we're looking for, because Seasonal Trader's chart shows you very clearly, is this end of year seasonal pattern, which is extremely, extremely bullish. And looking at our trading strategies, all of our long and short strategies, so we have a total of 8 strategies, combination of long and short. Trading our strategy just since 2019, um, getting into long trades between the middle of September and the middle of November, meaning get established positions anywhere in this time period. When we get a long buy signal, this is the win to loss record during that time. 95% winning trades on the long side. That's better than any individual ETF. There's a very definitive bullish bias to the end of the year, but we don't just jump into it randomly, arbitrarily. We wait till we get one of our buy signals from our strategies, and from our buy strat, that's when we know we have an even higher probability of getting a winning trade from that long strategy. Okay, so on the short side during this time, it's a 12% difference in winners, because the end of the year, there's a definitive bias. So just from trade signals we get with our strategies, and some of you are already trading the strategies, so you know exactly what they are. Taking those trade signals between the middle of September and middle of November, and these are option trades, so options are going to be good for at least 60 plus days. So you give yourself enough time for the rally to happen or a market push higher to happen. And it's, like I said, this is one of the times I consider the single most profitable time of the year to trade. there's a certain stock I used to trade at this time every year. I personally don't trade it anymore because I do business with that company, so I stay away from any conflict like that. But those of you who know what the stock is, then you know what I'm talking about, where you get in this time period and then you write it up for several weeks. It's also an earnings trade. And the thing has maybe been one losing year in the last 20 years. It's only been one losing year in the last 20 years where that stock didn't go up during that time. So, but some of you know what it is. Well, I'm not going to talk about it, but since I do business with them. So I stopped that back in 2011, trading that stock. So, but this is the time when, and on the seasonal charts, when you look into seasonal charts, if you see choppy sideways stuff like that, there's no definitive anything, okay? But when you see a several month long move higher like this on the seasonal charts, that stands out as something that you can capitalize on. You don't get, once again, you don't get in randomly. You wait for one of our official buy signals from our trading strategies and get long. So some of you just exit at the first target only. This is a time of year when you might even consider taking part of your position off at the first target and then having a secondary target and trailing a stop on remaining contracts. If there's any time of year to do that, this would be it. Okay. This is the best time of year to look for a bigger move. So getting out part of your position at the first target, great. But there's a good chance you might get a bigger push higher. So here's where you have a secondary target and a trailing stop on remaining contracts. And I'm going to put the link to the handouts is in the chat window for anyone coming in now. All right. So anywhere along the way, I want you to go ahead and stop me and ask questions. You don't have to raise your hand. Just either unmute and ask the question or type in the chat window and I will see it there. Before we move on, I'm going to go, I usually do a big picture overview of the markets and see where we are right now. So I'm going to go back from this seasonal pattern right here. I'm going to switch over to the charts and we'll do a big picture overview and then we'll come back to the seasonal pattern. All right. So usually show this because it's interesting how predictable it is and how tradable it is when you understand the big picture and you don't panic. So when you hear people in the news panicking, it's like big deal. It's just an opportunity for us to make money because we understand the big picture so we don't freak out. But this is a monthly chart of the S&P 500 SPY. And this is, we're all the way back to 1999 here. This blue line is a 40 period moving average, and this line here is an 8 period moving average. So when the market is in bullish mode, it usually rides above the 8, periodically pulls back to the 8, pulls back to the 8, pulls back to the 8, and then eventually we'll get a couple closes below the 8 and we'll drop down to the 40. If we get two closes below the 40, we will tend to go lower. Okay. And then when we go lower, we'll go up to the 8 and up to the 8 and up to the 8. So every major rally up to the 8, if you time that with our sell signals on our daily chart, so if we were rallying up and on our daily charts, we get sell signals anywhere in this area, cha-ching, it's a major plus for us. If we are rallying up and we get a pullback and we get a buy signal anywhere near the 8, cha-ching. Those are the biggest moves, and you can go more than first target. You can catch a very, very nice moves off the 8 when we get buy signals right near the 8. All right, so this was the tech bubble crash in 2001, and then eventually rallied back above the 40. This was in 2004. Once we go above the 8, we just keep pulling back to the 8, pulling back to the 8, every pull back to the 8 on this monthly chart. If you see buying opportunities, a signal on the daily chart, this is your best trade. You get anywhere down here near the 8 and you get a buy signal off a daily chart, take it. You get any pullback, it's pulling back, getting close to the 80, you get a buy signal. That's the money maker. All right. Once again, you get a couple of closes below the 8, and it pulls back to the 40. Back to the 40 is also another buying opportunity. You got a nice rally off the 40, off the monthly. Any pull back to the 8 or the 40 is a buying opportunity. This was that 2008 debacle in the market where we got our two consecutive closes below and the market went lower. Okay. This was a 50% pullback in the market that year. Literally, the market dropped 50%. And everyone's freaking out. Everyone thinks it goes to zero, of course, but that's the way people think. But if you now, when I'm working with new coaching clients and we go through daily chart strategies, I always make sure I go through this period with them from the middle of 2007 all the way till this market decline ended and we rallied back up in 2009. I always make sure I go through this period with them with all of our daily strategies to show, because if you can't make money when the market is going lower, then whatever you're trading is inadequate. You got to be able to make money when the market is going down, not just up. Okay. If you only make money when the market is going up, you're an investor basically, um, and hoping the market goes up. If you're a trader, then you should be able to make money with the market going up or going down. You shouldn't be just stuck there hoping for the market to go back up. So I always go through our strategies during this period and show when we trade our strategies per plan, it was actually in the neighborhood of 90% winning trades during this period of market decline. We had about 90% winning trades trading our strategies. And that's because um, you follow the plan. Everything is, you don't just back test something and say it's going to work. You also have to forward test it. You have to trade it with live money, live capital. And we've been trading pretty much the same way for a long, long time with real money, just buying calls and puts. So we know it works. So that's how we've gone through the fire. We've gone through the ups and downs. We've gone through the blowing out accounts for all the wrong reasons. We've gone through all that stuff and come out the other side. And one thing that works for us is we just buy calls and puts, no spreads, no spreads, and no spreads. Keep it real simple. But you got to follow a certain set of rules to make it work. All right. So after the market rallies back up in 2009, we get back above the 40, and we haven't really spent much time below the uptrending 40s since then. Every couple of years, basically, the market will pull back to the 40 buying opportunity. If you're a long-term investor, every pullback to the 40 is a buying opportunity. Anywhere in this area, if you're the long-term investor, here is where you'd be putting up, adding to your positions. And if you are a shorter-term trader, every pullback to the 8 or the 40, you time that with our buy signals from our daily charts and you get much better moves. Right? Once again, pull back to the 40 every couple of years. But in the meantime, pull multiple pullbacks to the 8. It just rides the 8. And 8 and 20 is something learned from John Carter and Hubert Centers from Trade the Markets way back when. They used the 8 and 21. And I'm using 8 and 20 for this. And it's going to be 8 and 821 and also the 40. But the 8 was the moving average that the price rides. Whether it's on a daily chart, weekly chart, or monthly chart, it rides the 8, okay, on that time frame. So multiple opportunities for long-term investors and also short-term traders. Every pullback to the 8, you look for that buying opportunity when we get a buy signal on our daily charts. And it works extremely well. Here, this was 2020, COVID. This drop lasted a whole 3 weeks. Huge, massive drop. Um, very, very profitable put options. I mean, we were getting 60, 70% returns at the first profit objective. It was massive gap after massive gap after massive gap. Options exploded in price and value with a premium, and then all-time massive rally right off the 40. And one goes back to riding the 8, riding the 8. Right? This was 2022. We had a pullback for a couple of months, and whenever the market pulls back, you're going to hear doom and gloom on all the news. But on our end, we're below the eight. It pulled, retraces back up the eight, selling opportunity, retraces up to the eight, selling opportunity. Coming down to the 40, buying opportunity, down to the 40, buying opportunity. Long-term investors should be salivating. Short-term traders, every pullback, you time that with our trade signals, cha-ching. Okay. Just a couple of months ago, this was a big giant red candle. I think it might have been January or February or earlier in the year. Um, when this was a red candle coming down to here, I told on the meetups, you can go back and look at those from earlier in the year. I said, wait till the market drops another 10% or so and it pulls back to the 40. So it did. It dropped another 10%, pulled back to the 40 and rallied. But everyone is thinking, oh, tariffs is going to go to this, once again, we're going to, market's going to get crushed. Don't follow, don't listen to news to drive your decision making. Look at the objective charts on the big picture, not the small day-to-day stuff. That just shows a lot of volatility. When you look at the big picture, you know exactly what's going on. And this has been an uptrend since 2009. Nothing's changed. We get a periodic pullback. We need something in the news to drive the pullback. And here's where we are right now. We're looking for something to make it pull back again. In an ideal world, the market pulls back at least to the eight, preferably lower, and then we get our buy signals for in the September October timeframe over. So that's in an ideal world. So now I'm going to switch back to, and if you have any questions, like I said, just go ahead, unmute and ask, or type it in the chat window. I'm going to switch back to the handout for a moment and share. Okay, so this is what we're looking for to happen. And I'm going to go through now. I'll show you this is the number of wins and losses just since 2019. Becky is the one who tracks all of these stats. She's does it for a living, and she's extremely good at putting all this stuff into spreadsheets and tracking it. She's the one who puts out all those monthly spreadsheets with all the wins and losses for each of the ETFs and future symbols and tracks that back. Although I'm only showing 2019, this data actually goes back to 2000. Okay, so or even some of them even before that. So the Dow SPY, and Nasdaq, they go back to 2000. Some of the other ETFs start in 2005 or 2006. So we have a lot more data, but the only things we made available so people get a feel for what things are like is for the last 5 or 6 years, because people were asking to see the visual of the wins and losses to see how money's made, and that's why we did that over the last couple of years, so people can see how money gets made and they can do a sort through for themselves and do an objective review on their own to see the wins and losses on their own and check everything out independently. So it's all published on our website. Okay, so let's see. I'm going to switch to a spreadsheet that shows the trades also. And we'll probably put that up on the site also a little bit later on. I'm going to share and daily ETF trades. Okay, so this is the listing of the trades that generated these statistics with 95% wins. Okay. And these are only the trades which become valid between the 15th of September and November 15th, that period. The seasonal pattern isn't done yet, but we need November and December for the continuation of that pattern to be able to market to rally and hit our targets. So we don't want to get in at the very top of the seasonal pattern. We want to get in at a lower point and give it time to actually play itself out and rally. So I was out of curiosity, I was wondering, would this have worked in 2008? Would we have gotten, because the market just got destroyed in September, October, November of 2008. The market just got destroyed. Would this have worked to keep me out of long trades, or how would long trades have actually worked out back then? So when I went and looked at the charts, we had zero trades valid on the long side during that period. Zero trades were valid on the long side. I looked at the S&P and we had zero trades valid long on the S&P. It was all short trades valid. So that's another key thing. Don't just assume markets are going to go up because it's September through um, November. We trade our buy and sell signals. Yes, the bias is on the upside, but we have to wait for our valid trade signals. We have to wait for the valid trade signals, not just jump in long until, because as an example, I have the long trades here and the short trades here since 2019. Let's take a look at this is the short side. Take a look at the end of 2024. This is all short trades became valid from September through November 24. Look at all these short trades that were valid and winners. Okay.
Hey,
So,
F.
hey, David.
Just to confirm, so looking at the seasonal chart, I understand that the rally on the positive direction will start like in October, but for September and end of August, so end of August looks like it's trending up, but September looks like it's sideways.
Correct.
So, do you focus on futures or options during the September month
In the
in particular?
September, because of rollover and quadruple witching and Labor Day holidays, we don't trade during futures during those times.
Hmm.
So that's basically 3 weeks, almost 3 weeks that we don't deal with futures. But with options, we can survive the swings up high and low.
I see, because of the 2 month expiration cycle.
Exactly. And
Okay.
like I said, we don't really get fake outs. We don't get too many fake outs with the option trades in this period. Um, like even like I said, in 2008, we got zero buy signals during this period. It was all short only. Just like last year, we got so many sell signals. You can't just impose our will on the market. Say, hey, we're going to go long because it's September through November, and we saw this presentation where it was 95% wins. So we're going to go short. I mean, no, excuse me, we're going to go long. No, you have to wait for the valid buy signal. That's your edge. If last year we got a whole bunch of short signals, those are the trades you take. You're on the short side. NASDAQ short. Lots of shorts here. Okay. Um, but now take a look. There are multiple markets going on. We have the major markets and we also have the metals. We have oil. Okay. So it's not just one market we're trading. To look on the long side, the end of last year, we had a
Gotcha,
couple
makes
of long losses.
sense.
We had a couple of long losses, but the long losses were not on the major markets. It was oil, materials, home builders, biotech, biotech. All the long trades on the major indices, the stuff that actually tracks the S&P, those were all wins. So when we put this out here, you have to take a look closely. These are not Oil is not expected to track the major markets. It will not be correlated highly with the S&P. Okay. So during this end of year, if I see a buy signal on US oil and I see a buy signal on the NASDAQ, and you have to pick one of the two, David, which would you choose?
NASDAQ. Yeah.
Exactly. Um, because oil is not something that's highly correlated. It's energy and oil that's a whole different life of its own. Okay, not highly correlated with the Dow, Nasdaq, and S&P. So the things that are highly correlated with the Dow, Nasdaq, and S&P, those are the things you want to trade long when those buy signals happen. So if you have a choice, That's what
Gotcha. Because the seasonal patterns are, I think it's just the S&P, right?
S&P, well, S&P, Dow, and Nasdaq, the three big ones.
Okay. All right.
But if
Gotcha.
you take a look at the losses from the end of last year, U.S.
Hmm.
oil doesn't really count.
Right.
U.S. oil doesn't really count. It doesn't track the major markets. Biotech doesn't really count. They have a life of their own. This one, home builders, okay, that one's more correlated with the market. So we had one loss long. That's a real loss of that time period of things which actually track the major markets.
Hmm.
And I
Makes
think from a
sense.
previous presentation, we get our absolute best results trading the Dow, Nasdaq, and S&P, and anything that actually tracks the major markets.
Yep. Got
Um,
it.
yeah, but even here, last year, the shorts were the big winners here, a lot of them. So we had good trades long and short last year. But overall, when it comes to it, and just going back in the last 5, 6 years, it's still 12% more losses, 83% wins compared to the long side, which is 95% wins. So basically, when we get our buy signals, take the trade during that time if at all possible. Um, if you can afford it and it fits within your portfolio and everything else, the long side is the way to go. But that doesn't mean shy away from the short trades. Always,
Be very
um,
picky. So
yeah,
the ones that are very correlated or a
yes,
much better entry.
yeah, or better entry. Like you get a better price than expected, where you
Yeah.
might get if you get in at the open price the next day after it's valid, you might get a 10 to 15 to 20 something percent return, but getting in a couple of points better than expected, you suddenly get a
Hmm.
40, 50, 60% return at the first target.
Yeah. Makes sense.
Have you been doing multiple targets on option trades,
Not
David?
multiple targets, but I do wait. Now I tend to wait a couple of days, and
Okay.
I usually get much better entries. So like on average, I think my return on trade is like 35 to 40%.
Yeah. And so I also set up a couple of the futures trades and option trades on Collective 2. So I'll show those in a couple of months, just gathering data. I'll have a full year of data for the futures, and I just started posting trades on Collective for the option strategies semi recently. So stay tuned for that. That's something um, I've been wanting to do for a while, so I finally started doing that a couple of months ago. So I'll show that in a couple of in a few months, maybe early 2026. I'll present the Collective strategies. Then people can follow them there or trade with them and so on and so forth. And Collective is a site where you can um the third party that you can trade your strategies and objectively have them track the results. That's Collective 2. I think it's called collective2.com. They've been around for 20 something years now. I've used them before, but they're a third party where they can track your trades for you and objectively show how what the results would have been if people were following, and then people can subscribe to follow those trades there and trade along with you. It can also auto trade if that's set up for that also. Okay, do you have any questions so far on this stuff? Okay, so every year I do put out that this seasonal pattern is the one we wait for. I'll take a quick look at one of the charts. I'll go with the S&P and one of the strategies some of you have seen before, some of you might not have. I'm going to change the share. Okay, SPY. Okay, you should be looking for the S&P right now. If you want to look at a different ETF, let me know. Um, this line is a Donchian mean line from a Donchian channel indicator, mean line. And this is our 40 period moving average, 40 period simple moving average. This is a daily chart of the S&P 500. Um, this is, I think, one of Becky's favorite trading strategies is the Donchian crossover buy. And from a visual point of view, it's simple. We're looking for the orange line to cross the blue line. People ask me, how can I find the schedule or find the trades quickly? Okay, let's say this was Today, did the orange line cross the blue line? No. Another day goes by. The orange line cross the blue line? No. Did the orange line cross the blue line? No. Did the orange line cross the blue line? No. 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 Hey, orange line crossed the blue line. That's the setup. And the trigger conditions is a few other things to look for that relative. So setup trigger trade management terminology from Jake Bernstein. So the setup is very visual. Here's what I'm looking for. I'm looking for these two lines to cross. If the two lines don't cross, boom, next, 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 next goes really fast. Um, I know because Becky maintains the stats when these two lines cross on S&P 500 that there is a over an 85% chance that um, this market is going to go higher by at least one ATR from the open price the next morning. So the ATR on this day is, if you look at the data box over here, ATR average true range is 10.38 points, meaning on average it's moving $10.38 or 10.38 points every 5 days on average. So it'll be the 5 period ATR. So if we're opening the next day at 583.41, we're looking for it to move 10 points higher within the next 1 to 2 months, basically. That's how much time we're going to have an option depending on the stats and the strategy. So the ATR is 10.38. The open here is 583.41. So we're going to 593 70 something. When did it go that high? 589 was a high, 588, 590, 594. So sometime this day, our target is reached. A quick move like that, you're looking at a 20 something, maybe 30% return on the option, depending on which option you chose. And we give the stats to show if you have 1 month of time, here's the probability that it will hit the target before expiration. If you have 2 months of time, here's the probability it will hit the target before expiration. You make a decision. That stuff I go over with you, and we update that information every 3 months. So let's take a look at this. When we see this, here's what we know. We have our stats. We know it's going to be 85% or higher. It's probably more like 88, 89% for the S&P. But everything we do is technical. We do not look at news. We do not do looks like, feels like, that type of stuff. But if we do see a big news event and it's driving the markets, yay, because now we have something maybe more fundamental also driving the market. So even better probability for us of success if something in the news or something market moving event is happening to drive the markets and it's combined with our buy and sell signals, those are the best trades. So when the tariff thing was out and we saw these sell signals, yay for us. Because it was something that was a kind of a negative cloud on the market and we were getting all these sell signals. So beautiful. You got something big worldwide, globally affecting markets, and we getting sell signals. It's an easy one. Take the trade short. Um, so
And
but
just out of curiosity, how
yeah,
was the ATR 5 day determined? So I noticed that that's valid like for all the daily strategies.
except for one of the weekly, we have 20.
Hmm.
That was and a 20 was an accident.
Okay.
We had literally, myself and Becky literally finished all the evaluation, all the back testing, and then realized we had the ATR set to the wrong value at 20 rather than 5.
Oh, geez.
So since we already done it works, we left it at 20.
That's funny.
But other than that, we've always used 5. I think we may have gotten the 5 from when we were back in doing day trading, because we were looking for shorter term moves, that type of thing. But we just sort of kept it and it worked for us. Not that some other value is going to be wrong or anything. It's just that once you find something that works, you just sort of stay with it. And
Yeah.
we've just been consistent with it. The same way once we found a 40 works for us, we just kept it. We're not going to have a 40 and a 45 and a 50 and a no, the 40 works for us, we keep it. So that's the big thing in the market. Once you find anything that works for you, keep it. So the 5 was working, we just kept it. No other reason. It could have been a different value, would have been fine also.
Yeah, I mean, I agree with you. It works. It works fine. I was just wondering, but cool.
So this is not day trading for the people who might be seeing this and thinking, do I have to sit there all day to look at this? No. You have a trade signal which we see after the market is closed, not when the market's open. After the market is closed is when we see this trade signal. This happens after the market is closed, so you can casually do your evaluation, get option pricing, and I have to show you how to determine option pricing because we're just buying calls and puts. But if you pay too much, you're going to get killed. So but you have a higher chance of time decay. With the ETFs, we don't have the same issues with implied volatility as we have with stocks. Stocks can get a volatility crush like that. We don't have the same high implied volatility and volatility crush with the ETF. So that's why we can trade it very comfortably with just buying calls and puts without having that volatility issue, implied volatility. So the next day, at or below the open price, if the market opened at 583.41 the next day, at some point in time when the price is below the open, we're going to be buying at least the 583 call option. And with an expiration of 1 to 2 months out, depending on the strategy and the stats, and put in a conditional exit order to exit when the first target is reached. And the first target is going to be the 1038 ATR value from this day added to the open price the next day, which is going to make it 593.70 something, which is hit over here on this day. So you just put the trade in and walk away. You don't have to sit there in front of a computer monitor. You're going to exit at market value of the ETF, I mean, of the option when a target's reached. That's it. You put a conditional exit order in to sell at market my call options when SPY is at or above the target price, which is hit sometime during this day. And that's how we trade. By doing that, we don't have to sit in front of a computer all day long. We don't have to sit there for hours making decisions in real time. We can have a life, a job, go do things. And what myself and Becky found out a long time ago, because we used to sit there for hours every morning, day trading NASDAQ futures and Russell futures, and we were good at it. We even traded Q's options, which was absurd to do, but we didn't know it was absurd to do until later on when people told us, why are you day trading options? Options are not, that's the worst thing to try to day trade is with options because options require either time decay or a big movement to actually make money. So we didn't know that initially, but that's when we switched over the futures and we were doing really, really, really well. But then we also had jobs and lives. So we couldn't sit there for hours at a time. And what we also figured out eventually, the same amount of money you make or lose sitting there for hours and hours every day trading is the same amount of money you make or lose sitting there for minutes every day swing trading. You don't make 10 times more money because you're day trading. You actually need less capital to swing trade to make the same amount of money you would um, making day trading. Day trading, you want a little tiny move to capture profits. When we are swing trading, we're looking for big moves to capture profits. So with we can make the same to make this much money for this much of a move for day trading, we need a lot of capital. To make this much money with this big a move, swing trading, we need a lot less capital. Okay. So it's just so much easier, and that's part of the growth of us being traders. We eventually evolved from doing that day-to-day labor-intensive job to moving up and up and up like management. So you're doing less work, making more money, um, and it frees up our time. I know Becky's been having fun recently, doing all this traveling around and doing things because she has free time. And I have a ton of free time that I do everything that comes up, whether it's acting and stunts. I'm involved with city government. I train in jujitsu. parkour. Um, I get calls. I teach fitness classes, kickboxing fitness classes, boot camp. I train in Brazilian Jiu-Jitsu, so I'm always out doing something because I have time. And then with my time flexibility, whatever comes up, I get a call, hey, you available to do this? I'm like, yeah, sure. And that's all because of trading. Uh, Trading, it just takes a couple minutes a day for me to place a trade and go walk away. I just put my exit order in. That's it. And it's been my foundation for generating income for quite a while, but it works. And it's just for me, just a routine. I still spend probably an an hour to 5 hours every week just looking for ways to make more money from the strategies. How can we get a little bit more out of it? That's an ongoing thing for me, and it's stuff I kind of like doing actually. So you'll probably see some updates in a few months for some of the future strategies, and maybe one more short weekly chart strategy for the options. So anyway, and this is a pattern that you see happening all the time. This was the last couple of S&P trades. Orange line crosses the blue line. Cha-ching. Orange line crosses the blue line. This one's even a better trade because the market opened and then dropped. So here, the target would have, the ATR is 6.4. So the target would have been 6.4 points added to the next day's open of 560. So it'd be 560. The target would have been 566 something. So open was 560 and the ATR is six something. So the target would have been 566 something, hitting right here on this gap up. But you don't have to get into the open. We have lives. We're doing stuff. Maybe you got in a day later, or 2 days later, or 3 days later. If the original entry was at 560 and a couple days later, you're down at 550, you can get in at 550. And now instead of having a 6 point target, you're getting in 10 points lower than you had planned on getting in. So now you, instead of having a 6 point target to the first target, you now have a 16 point target. Here you would have probably gotten your 15 to 20 something percent return. You entering around the open and exiting on that gap up. 10 to 15 to 20 something percent return. But let's say you got in a day later, or 2 days later, or 3 days later, or 4 days later. Now instead of having a 6 point target, you're getting in 10 points lower than expected. You get in at 550 rather than 560. Now you have a 16 point target because you're getting in down here at the strike down here. So now when this first target is reached, you're not looking at a 15 to 20 something percent return anymore. Now you're looking at a 50, 60, 70, 80% return at the first target. Okay? 10 different people taking this trade will get in on 10 different prices at 10 different days. Okay, so they'll have all different results. They may all be winning trades, but we had 1, 2, 3, 4, 5, 6, 7, 8. We had about 10 days to get into this trade before it went back above the open price. So the entry is at or above the open price the day after the trade is valid. So we could have gotten in anywhere down here. A couple of points lower translates to a lot of much higher percentage return. Because what would you rather have, a 6 point target or a 16 point target? Or even lower, a 26 point target for your option? Because different people will get in all different prices. All right. And these are some of the best trades. The probability of success might say on the trading plan 88%. It's 88% whether you get in here or here or here. There's still 88% chance that target will be reached. The only difference, if it's meant to be a loss, it's going to be a loss. But if it's meant to be a win, it could be a 15, 20 something percent win. It could be a 60, 70% win, or it could be a double to triple your money type win. Okay, it all depends when you get into it, but it's valid until it goes above this entry price or until the first target's hit. So that's one of our biggest ways to just maximize profits. Like David was saying, he's getting better at getting in at a better price than expected. Getting in at a better price than expected increases your profitability significantly. And the more patient you are and be willing to risk missing a trade. So if you're willing to risk missing a trade, you're going to get some really big trades. And one or two of these trades from pullbacks is more profitable than three or four other trades combined getting in at the open the next day. Okay. Also more effective use of capital because one trade getting in down here is the equivalent of three or four trades getting in up here profit wise. So getting in, the more patient you are and be willing to miss some trades. So because this could have opened and taken off. An example, like one of the other trades we looked at, um, the first one we looked at, it opened and then took off. There was no pullback. So if you're waiting, you missed that trade. But this one pulled back, it opened and then pulled back immediately. Best trades. The probability of success doesn't change, but the amount of profits significantly changes. That's why I'm hoping for a pullback for the end of the year for the seasonal pattern and then get an even better price than expected and capitalize on that end of year. So that's what I'm looking for next month, just to go back to the handout for a second. But this is a strategy, one of the strategies we use long. There are multiple strategies which we use, but it's just one of them. But because you can see, it happens, the trade happens all the time. It's a great bullish strategy, crossover, buy. You want to look at another ETF, let me know. I'll pull it up. Crossover, pull back for 1 day. So you had 2 days to get into this trade, then it took off. But it happens over and over again. As long as you're very consistent with your trading, get another one. Crossed over, buy. With that gap up, is those gaps give you the 30 to 40% return on a gap like that. So, but as I said, these trades happen all the time, and it's that simple a visual to look for the two lines crossing, and we have a buy signal. As soon as we get that, we double check the details of the trading plan for the trigger conditions and place the trade. We now know we have an 88% chance, somewhere in that neighborhood, that the market will go higher at least by one ATR over the next 1 to 2 months, depending on the strategy and the stats. Right?
Eversley,
Yeah.
I have two questions. Yes, I'd like to see another ETF chart, but
Which one?
I missed the part where you said why not futures at this time period, or
Oh,
why yes.
okay. We don't trade futures during holidays, rollover week, and quadruple witching week. So the first week of September is the holiday. That's Labor Day. And then immediately right after that, you're going to have rollover and quadruple witching. During rollover, you get a lot of fake buying and selling. And you and as the contracts change, let me hang on. I want to pull up a futures contract here. I'm going to show an example of uh, do NASDAQ. Okay, so when the contract changes over, this will be the second week in June and rollover. Where you see, okay, let's see, rollover, let's see, 5, 6, 7. Okay, here's rollover right here.
Okay.
Okay, so the old contract might be here. The new contract is going to be a totally different price. If I'm looking at the June expiring contract, that's the closing price right there, that red candle, right? As an example.
Okay.
If I continued and did not switch over to the September contract, there would be no gap down here type of thing. You see how it closed here and then opened down here?
Hmm.
That's a contract change, not a real price change.
Oh,
So if I was looking at the exact same June contract, because the June contract is still trading for the next week, there'd be no gap.
okay.
So since the rollover creates some fake numbers relative, it throws the technical analysis off for a while. So
Oh,
that
okay.
is why when we're looking at the daily charts, when we were doing commodities, we had a cool way of doing that, but on a different platform. But with when it comes to rollover, let me get the right rollover dates
And
too.
while you're getting that, it's just basically like you were saying, expired contracts is throwing it off. The price is not really changing. It's just contracts expiring.
The new contract is not the same price as the old contract.
Yes. Okay.
And sometimes people don't realize that they're two different prices. So when you switch, you might see a gap of 50 points, but that's on the chart. All we see is a 50-point gap, but it's not a real 50-point gap. It's just because we're changing contracts and the new contract, one contract is here and one contract is, let's say this is June, this is September. They're both doing the exact same thing, but
Okay.
when we change over contract, we just switch from here to here. But on our charts, we don't know that. It's not obvious. But all we did was change from this contract here to this contract. It's the exact same thing, but now we're trading this one. But they're doing the exact same thing, but we're just switching over. But
Okay.
do all the indicators, or whether it's stochastics and moving averages, the indicators don't know that. So they factor that in and create buy and sell signals that might be fake because the numbers are not real. So we allow a couple of weeks to go by to flush out that changeover and smooth out any errors in the charts caused by that.
Okay.
So that is the reasoning for um, we don't trade futures during those times. And the people who do trade futures during those times, I make it quite clear. I know David's done it. You're trading at your own risk and you're making a business decision. Proceed accordingly. And all and the reality is with the futures, probably 50, if we left all the trades in during that time, because we have all those trades documented, um, where we have strategies that are 90% winning trades, if we left in the trades that happen during quadruple witching and rollover, that 90% would be down to 70 something percent.
Hmm.
That's how we've been able to maintain a very high percentage wins with the futures by literally not trading during those times. And that's something we learned also when we were day trading. Um, it's foolish to day trade during Fed days. And when the Feds make an announcement, because all your normal technicals are thrown off because people are posturing for Fed rate announcements and stuff like that. They just throw what the Fed might say. So all your normal technicals are off.
Okay.
And
Eh, on,
so we learned that quite a long time ago from our day trading days, and that carried over to our swing trading. And so we factor all that in, but it's heavily based on futures because we can't afford big swings in futures. We have a hard stop. Options, we don't have a hard stop. We just buying calls and puts. They can go through the swing. We do our risk management by if we want to risk $1,000, we buy $1,000 worth of options. And we don't have to have a hard stop. It's just let it go through the swings. Futures are different. We have a hard stop.
and just to
Okay.
confirm,
Yeah.
if you
Thank
enter in
you.
rollover week, which is the second week of September, right?
Yeah. Our second
Let's
week of
say
the second Friday.
second Friday,
With the week of the
second
second
Friday.
Friday.
Yeah. So technically,
Yeah.
you could still have your positions open on the initial week, right? Like Monday to Thursday.
You can, but here's the thing. you need to do the rollover on Thursday because after Thursday, your target will be based on
The
the
following,
prices of
yeah,
the next contract.
gotcha. That's true.
So there are some times when the price difference will help you make some more money, or sometimes you'll end up making less because it
Yeah, the discrepancy.
exact
So,
that difference in contract pricing.
do you do a rollover or do you actually close the June contract and open up a new September contract?
That is a rollover.
So you
That
close the trade basically and you open a
Yeah,
new one
and
at markets.
depending on what platform you have, you do it in one transaction, which is the smartest thing to do because it saves you from yourself. In one transaction, close your close your June, open September in one order, and done. And it's then you put back in your target and stop loss. Same target and stop loss you had for the June, you put the exact same thing in for the September, except you might have been 100 ticks away from your stop loss in June, but after you switch over, now you're only 80 ticks away because of the price difference in the contracts.
Yeah, I guess I just wanted to confirm. Let's say that in your June contract, you are on a drawdown, right? It hasn't hit your
Yeah.
stop loss yet, or you're on a drawdown.
Yep.
And if what I'm hearing is you close the contract to open up a September contract, you're
Yes.
technically booking that loss.
Well, you book the loss every day, no matter what. Remember, there's a futures. It's end of day. Your losses are booked or wins are booked because it starts out fresh every day. So that happens anyway. Mark to
Okay.
market. So that happens every day anyway. But yes, in one transaction, you will close in a position, open a new position right away. So you don't allow any slippage. Whatever the new contract price is, that's your starting point.
Oh, so that would be this. So that new candle on the September contract would be the starting point and not the previous values of the June contract.
Correct, because they're both the same, but they were different. Like I said, here is this might be June, this
Yeah.
might be September. So as soon as you close June, you're going to be in September here. They're doing the exact same thing, but they're two different contracts. So the pricing on one is not the same as the pricing on the other. As soon as you close this one, you will be here now. And that might be a certain number of ticks lower. Um, that means so that's the price is the price. Sometimes it's to your advantage, sometimes it's to your disadvantage. My argument to that is it all balances out over time.
Gotcha. Okay.
It all like the people who complain about slippage and options. Well, have you ever heard anyone complain that they made too much money when the option price slipped and they made more than they should have made? Nope. But the same way you have slippage and you end up making less than you should, we only notice that,
Yeah.
but it works both ways. So things just balance out. So I don't really care. It all balances out. Sometimes it ends up better, sometimes it ends up worse, but the numbers all work out fine anyway. Not a big deal. But those are the little nuances and futures that you have to go through rollover to experience. And you want to like, this doesn't seem right. The numbers are off. But that's the way it is. They're not exactly the same. Okay, I was going to go back to, unless we have any more questions, I'm going to go back to the handout. Okay, I'm going to go back to the change the share. And you can talk about anything you want. Just feel free to ask and we can. Oh, person that was asking about an ETF. Wanted to see a different ETF. Is that Mary? Did you want to see a different ETF?
Yes, and it's Marcy. I forgot the C.
Okay. Which one? Which
Just
ETF?
another example.
Okay. Let's go totally different. I have no idea what the win-loss stats on it offhand. Let's take a look at XLE energy sector.
Yes, thank you.
This was one of my first favorite ones to trade back in 2006. Okay, last
And
price.
while you're searching that, you're saying that you just haven't, other than you tweaking your system, everything you've been doing since, let's say, 2008, 9, 10, it's just working still.
Yeah. We haven't traded trade management. Some of the strategies we've tweaked. Some of you know I traded Ichimoku strategies. We just switched those over to a lot of the Donchian strategies. The trade management is the same. The only difference is we get more trades with the Donchian. That's the only difference. We're just getting more trades. But how we manage positions and the profit and loss has been the same forever. It just works.
Okay.
But some of the strategies we tweak it. But so here's XLE energy. The last, once again, each day we go through the review. Did the two lines cross? No. Nope. Hey, it looks pretty close. I can't really tell with your eyes. So you look at the data box over here to tell. If you can't tell looking with your eyes, it looks like it might have crossed. So I look at the data box. Was it the mean line is orange, 83.919, and the blue line moving average is 83.12. Yes, it crossed. So then I go to my trading plan with the win-loss stats for 1 month and for 2 months worth of time on the option. We call it cycles, and we go through that. That's very well defined how what we call a cycle. I go through that with the clients in detail. Real important how much time in the option. But the ATR here, the $1.53, it's $1.53 added to the open price the next day. Note there is no pullback. If you didn't get in near the open, you're going to miss this trade. It just took off. So $1.53 added to this open price is the first target. Going back, this looks like it's going to be a loss probably. Crossover, definitely a loss for this trade. Let's see. I'll make it compress the chart a little bit. And this is Ninja Trader. To do the strategy, we use Ninja Trader and Toss, Thinkorswim. That one's going to be a loss.
Hey, Ev, I don't know if you noticed, but like think
And this one, and this
Ninja
one's a
Trader
win.
7 is no
Yeah.
longer downloadable from the website, only on Ninja Trader 8 and above.
Okay. They have a little box on the side to download 7. It was a link to it, a little. So when you go to the download page, it would show down Ninja 8. And then for people who needed 7 or the previous version of 8, there was a link off to the side, just in like text for previous versions. But
And
most,
all your analysis that you're doing is currently on 7 still.
no, I do everything on 8. I moved on to 8. Anyone who wants to trade 8 just have to ask me for the indicators and charts, but I've moved on to 8. But I use 7 and 8. I like 7 because it's warm and fuzzy. Because I've been using it for so long, but I have 8 also. And all my old strategies I've been working on are all on 7. So I only transfer stuff over to 8 as needed. But even this crossover here, it went against you for a while. But after within 2 months, targets hit. And like I said, we don't have to worry about implied volatility. It will be what it is. Some trades will be -5%, +5%. Some trades will be +10%, +20%. Some trades will be +50, 60, 70, 80% return at the first target. I don't worry about it. The numbers, as long as you keep booking positive returns, um, the numbers work themselves out to be net profitable. And another trade here, crossover, gap, pull back for a while. Best trades is the pullback trades, took off within 2 expiration cycles, 2 months. This one's not valid because we closed above the Bollinger Band. We don't get into trades that are really heavily extended to begin with. Crossover, good trade right away. Pretty sure the targets hit that very first day or within 2 days, the targets hit. And then we have other trade signals along the way. So that might be one of our first buy signals, but we have other buy as the market is trending. We have multiple buy signals going on here. It's not shown on this chart, but we have multiple buy signals and we have multiple sell signals. We have sell signals all at the top here. We have sell signals going on to capitalize on this move down. Multiple sell signals, multiple sell signals, multiple sell signals all in here. So we trade everything up and down with our grouping of strategies. 6 primary strategies and 2 supplementary for the Dow, Nasdaq, and S&P. This squeeze plays are supplemental. But very consistent returns as long as you're consistent with your trading. And the key is consistency. Trust me, trust the methodology. trust the stats. The key is the stats. So Becky is the key to making all this work because she maintains the stats. So without Becky, we don't do any of this. So like David, thank Becky one more time for doing this for us because she makes it work.
Oh yeah, for sure. Thank you, Becky.
All right, and next time you're out here, make sure we'll get a chance to meet Becky in person. When I used to talk about Becky, one of the guys who I'm coaching, he didn't realize Becky was a real person and thought Becky was an AI that I was talking about that does all the analysis.
I
But she's
believe
very
it.
good
Yeah,
at it.
she's
She's
very
very good at what
quiet,
she's very
but
good
she's
at what
great.
she does.
Yeah.
So I do all the in front the people presentation, and she quietly handles all the stuff behind the scenes. She's also the executive producer of my kickboxing videos, so she handles all the stuff behind the scenes, and I do all the stuff in front of the camera, and we complement each other because I will not put things in little rectangular boxes in a spreadsheet. I hate that. I hate that, and I hate that. I have all my trade literally documented each day on a little piece of paper here, each detailed out with all my futures trades and parameters. I can't do spreadsheeting. That would take me forever. But she loves doing the spreadsheeting thing. So I'm like, good, but we complement each other nicely doing that way, doing this trading. So, all right, so I'm going to switch back to the chart, I mean, to the handout, and I'm going to start wrapping it up. All right, so if anyone's interested in working on this with me, let me know, preferably by this Friday. Doing this discount, so I'm taking 250 off the coach, off the price of the options trading program or the futures trading program. And David was saying this past week with me also. He messaged me earlier. Um, Earlier in the year, we had a lot of future trade losses on the futures trades, so it was really slow for a couple of months on futures. But during that time, we're making money on the options. So doing both is really good because when one's not working for a while, other one's making you money and vice versa. So right now the futures are like cranking along. We're back in a groove with the futures and options have been just great all year long, literally all year long. Um, my normal price is 17.50 for the options program, and you take 250 off of that. Let me know by Friday. You can work on Thinkorswim or you can use NinjaTrader, either 7 or 8. I'm good either way. NinjaTrader 8, I have all the charts for it. I just handed to you. Thinkorswim, once again, I hand you the charts. If you're using a different platform, it'll be up to you to get the charts working on your platform, but otherwise, I will hand you everything you need for NinjaTrader or for Thinkorswim. You don't have to create everything on your own. And I do everything one-on-one, whether it's in person. If it's in person, I got to meet you in Santa Clara. I have a location in Santa Clara I can meet you at. Or we use Zoom. Good old Zoom has become popular the last couple of years, and it works really, really well. Um, I don't put a time limit on how many meetings we can have or until when. There are people who email me, call me years after, they paid me for this stuff, and they want to meet or talk. That's fine. I have no problem with that. People have been emailing me every day, every week for the last 15 years to confirm their trades are valid because from experience, don't assume your trades on you see on your chart are all the same trades you see on my chart. There are errors on charts and your chart might not match mine. That's why it's good to have other people to compare your trading results to, okay? Just to make sure. So if I put each day I put out what trades were valid. And if you sometimes someone will say, hey, I found this not valid. You said it's valid. I say it's not valid. Okay, so the exact same trade, and we go back and update our data, and one of us will have a change chart because one of us will have data that wasn't right. So it's good to be able to work with other people to compare data, to compare charts, because sometimes charts are wrong, data's incorrect, and we'll never know. It happens more often than you would even realize. Data updates at 2 p.m. Pacific time. However, it might, what you see at 2 p.m. Pacific time may not be the same as you see at 8 p.m. Pacific time because an error got fixed later on in the day in with a bad tick or something. So that happens regularly. So that's why it's good to have other people to work with. So if something comes up, it gets communicated. All right, so let me know and I can work with you. I just ask of you to commit to at least 3 to 6 months because we need to do this to see how the wins and losses translate to profitability and to get consistency. Um, I- I'm pretty flexible with my time to meet with people, but I need you to commit to that much time to see it work because you're going to go through the highs and the lows. You're going to go through profits and losses. There are going to be times when you're going to be second guessing things, and if you get through that, I got some people earlier this year. I had to talk them through all the losses and the futures, but once they got through the losses, they're like, "Wow, this has been a great year in trading futures." They're like, "Yeah, it has." But those first couple of months, you wouldn't think so but you have to get through that, and all of a sudden, bam, it just hits and hits and hits. And as I always say, every year you will have 2 to 3 losing months. That will be offset by 2 to 3 winning months, negated. That means the other 6 to 8 months of the year will represent your profits for the year. That's why you have to keep trading. You follow the plan, follow the routine, follow the structure, and the numbers work themselves out. And you have to get rid of old habits. Well, I'm going to place these 2 trades and see how they work out. No, you have to keep placing trades because you have to have enough winning trades to offset losing trades. If the ones you place happen to be the losing trades, what's the then you have nothing to offset it. So you have to be able to place trades, have the a right allocation of risk capital. So you can't risk 10% of your account on one trade because at some point in time you will have 3 to 4 losing trades in a row and you can't wipe out 40 something percent of your account and expect to be able to keep trading properly. So it's the 1, 2, 3% account risk max per trade, that type of thing. And we keep that set and then we trade consistently, no big risk of massive losses, as long as you have your risk capital allocated that 1 to 3% account risk per trade neighborhood. It works out really well. You can sleep at night without stressing of losing a whole bunch of money. All right. So anyway, let me know by Friday if you want the discount. But like I said, this is the best time of the year to get set up for this and to get ready for trade these strategies. It doesn't matter if the market moves up or down, we will capture those movements and capitalize on those trades. Um, so unless we have a question, I'm going to end the meeting now, and then we'll maybe pick up the weekend after Labor Day, and we'll go into futures. And in the middle of September, we'll do another options one just to reiterate the points we made today and get ready for that end of year seasonal one more time. Um, so, do we have any questions for the day? Anything else?
Thank you. It was very helpful.
And thank you. And I'll send the recording out this afternoon in a couple hours, and I'll see y'all in a couple of weeks right after Labor Day. Y'all have a good day.
You too. Thank
Thank
you.
you. Have a good
Thank
one.
you.
Bye.